In 1999, a Silicon Valley chef faced a choice that would define the rest of his life: take a bigger guaranteed paycheck elsewhere, or bet everything on a stack of stock options nobody could put a real number on. His name was Charlie Ayers. He wasn't an engineer or a founder. He was a cook, about to become roughly the 56th person ever hired by a young, year-old startup nobody outside Stanford had heard of. This is the story of Google, but not the one you already know. It's told through the one person almost everyone forgets, the man who cooked for the engineers who built it. By the end of this video, you'll know exactly how rich a company cook can become by betting on the right stock at the right moment, and what happens when that identical bet fails somewhere else entirely. Because at that exact same moment, in that exact same California boom, another company was making its own staff the identical promise. Only one of these two fortunes was ever going to survive. Charlie Ayers had cooked for the Grateful Dead's road crew before this. In 1999, a tiny, cash-strapped startup in California called him in for an interview. The company had no cafeteria budget. Just two 20-something founders, a few dozen engineers, and barely enough cash in the bank to cover payroll. Its name was Google. Larry Page and Sergey Brin offered Ayers two paths: a modest salary alone, or a smaller salary plus a slice of the company itself and stock that, on paper, nobody could yet price. 1999 was near the height of the dot-com boom. Across the Bay Area, hundreds of startups were making that exact same pitch: take less cash today, take a piece of tomorrow instead. One of those startups built a business almost every American recognized within a year: an online pet supply company with a sock puppet mascot that appeared in national television commercials. Its name was Pets.com. Pets.com had launched the year before, in 1998, and by 1999 was hiring at a blistering pace. It raised well over $100 million from investors, including a widely publicized investment from Amazon.com. It hired fast, paid well, and handed out stock options generously. Google, meanwhile, had almost no money at all. Its own founders drove second-hand cars and slept on office couches some nights. The stock options it handed out were, on paper, worth close to nothing. Two companies. Same California boom. Same promise made to their earliest hires: work for less now, and the stock will make up the difference later. Only one of those promises was ever going to be real. Ayers had no way of knowing which company he'd actually joined. Nobody did. Google wasn't even the leading search engine at the time. Yahoo and AltaVista dominated that market completely. He later said the pay Google offered was lower than what restaurants elsewhere were dangling in front of him, and that the stock options felt worthless to him at the time. But he took the job anyway, drawn in by the food budget Google actually gave him, and a hunch that this scrappy little search company might go somewhere no one expected. At the exact same time, across town, Pets.com was making its own new hires the identical promise: bigger salaries, plus stock options in a company that already looked far more secure. At Google, Ayers cooked out of a small, converted office space. Engineers ate off paper plates at folding tables, a few dozen people sharing one modest kitchen. He had almost no budget to work with. He haggled directly with local farmers for cheap produce and cooked simple meals: burritos, pasta, whatever kept engineers coding past midnight. Across town, Pets.com spent very differently. It rented real headquarters, hired a large staff quickly, and spent lavishly on marketing, including a commercial that aired during the Super Bowl in January 2000, reported at the time to have cost well over $1 million to produce. Pets.com's sock puppet mascot had already appeared in the Macy's Thanksgiving Day Parade the year before, in 1999. From the outside, the company looked far bigger and far more secure than a scrappy search engine still finding its footing. If you'd asked anyone in Silicon Valley in early 2000 which company would make its employees richer, almost nobody would have picked the tiny one operating out of a rented house. Ayers kept cooking anyway. He built out a real kitchen staff, expanded the menu, and grew close with engineers who would later run entire divisions of the company he'd bet on. He wasn't just feeding people. He was quietly building the culture Google would later become famous for: free food, casual chaos, and almost no hierarchy between founders and staff. Meanwhile, Pets.com kept spending faster than it earned. It was losing money on nearly every single order. Shipping a bag of cat litter cost more than the litter itself sold for. Here's the moment that quietly decided both fates. Both companies eventually asked their staff the same question again: take a cash bonus now, or keep holding on to your equity a little longer. At Pets.com, employees who had already taken options were told the company needed to raise more money fast. Investors were suddenly asking hard questions about whether the business could ever turn a profit. At Google, Ayers was quietly offered a chance to sell off some of his early shares privately, before any public listing even existed. He decided to hold on to every one. It's easy to look back now and call that an easy decision. At the time, it was anything but. Selling early would have meant real, guaranteed cash, and hand-holding on meant trusting a company that still hadn't proven it could survive. By late 2000, Pets.com had burned through almost all of its cash. It had never once turned a profit. The market that had thrown money at it now suddenly turned ice cold. Investors who'd once celebrated that sock puppet mascot stopped returning phone calls. The company began planning something it had never expected to plan so soon: how to shut everything down. Google, by contrast, had quietly cracked something nobody else had figured out yet: how to make search profitable, through small text ads placed beside its results. It wasn't obvious to outsiders at all. Google still looked small, still looked underfunded, still looked like the far riskier bet of the two companies competing for the same era's optimism. But inside that small office, revenue was climbing every single month. Ayers, still cooking, still holding onto his options, had absolutely no idea how much they would eventually be worth. Pets.com went public in February 2000, raising $82.5 million. Wall Street cheered. The stock opened above its offer price on its very first day of trading. Then reality hit hard. The company was still losing money on every single order it shipped. Within months, the very same investors who had bought in started quietly selling their shares. Subscribe and hit the bell right now so you don't miss what happens to both of these companies' employees next. By November 2000, just 268 days after its IPO, Pets.com announced it was shutting down completely and liquidating everything it owned. Employees who had taken stock options instead of higher salaries were left holding shares in a company that, within days, would no longer legally exist. Google, meanwhile, chose to wait. It never rushed to go public during the boom years. It waited for more years, growing quietly, staying profitable the entire time. In August 2004, Google finally went public, an unusual auction-style listing that left much of Wall Street confused about how to even value it. Shares opened at $85 each. By the close of the very first day of trading, Google was already worth more than $23 billion. Every early Google employee holding stock options, including one chef who'd once haggled with farmers over the price of vegetables, became a paper millionaire almost overnight. Charlie Ayers, employee roughly number 56, had been granted his options years earlier, back when the company was worth almost nothing on paper at all. By the time Google went public, those same options were suddenly worth an estimated 8 figures, reported at the time in the press as tens of millions of dollars. The exact number was never fully made public, since Google's early option grants weren't disclosed the way its post-IPO compensation was. But business press at the time openly called him one of the wealthiest chefs on the planet, a title no cook before him had ever held. Now compare that to a former Pets.com employee holding the exact same kind of paper company stock options worth precisely zero the moment the company folded. Same era. Same city. Same bet, trade a bigger salary for a piece of an improving company. One paid off beyond anyone's imagination. The other paid off absolutely nothing. The difference was never the size of the risk. Both companies looked shaky in 1999. The real difference was which business model actually worked once the boom finally ended. Google had found a way to make money quietly, without needing endless investor cash to survive. Pets.com never found that it needed the boom to keep spending faster than it earned. Ayers didn't cash out and disappear. He stayed at Google for years afterward, eventually running a large team of chefs feeding thousands of employees every single day. He left Google in 2005, reportedly a multi-millionaire, and used part of that fortune to open his own restaurant in Palo Alto. The restaurant he opened served the same philosophy he'd built at Google: simple, fresh food made for people who worked hard and wanted a place to unwind after. It was proof that the bet he made in that cramped kitchen years earlier had paid off in more ways than just money. The kitchen he once ran out of a converted house became the model for Silicon Valley's entire free food culture, copied afterward by nearly every major tech company. Pets.com's sock puppet Mascot, meanwhile, was sold off after the company collapsed. It later resurfaced as the mascot for an entirely different company, a strange final chapter for a brand once worth hundreds of millions. For the people who'd worked there, the shutdown wasn't just a headline. Desks were cleared out within days, and the stock certificates so many of them had been counting on suddenly weren't worth the paper they were printed on. Two companies started in the exact same year, in the exact same boom, offering the exact same trade to their earliest hires: less cash now, for a piece of tomorrow. One tomorrow actually arrived. The other never did. Not the founders, not the investors, not even the chef flipping burritos in that tiny kitchen could have told you which one in 1999. So here's the real lesson hiding inside this story: the size of the paycheck you turn down means nothing at all. What matters is which business quietly works underneath all the noise. Charlie Ayers turned a cooking job at a struggling startup into one of the strangest fortunes in Silicon Valley history simply by betting on people, not on a paycheck. If you had the chance to trade a bigger salary for stock in an unproven company right now, would you take the bet Charlie Ayers took, or would you play it safe? Tell us below.